Well, I think in credit markets, relative to equity markets, there's some really big differences. In equity markets, it's really difficult to beat the index for some of the reasons you just described, which is the big tech names continue to go up and up. By definition, equity markets are really about picking winners and the contribution of winners to the overall market. Whereas for credit, it's really important to avoid the losers. And so the selectivity is critical because the broad market, unlike the broad equity market, is actually relatively unattractive. There's some real crud in the overall loan market.
But when you say avoid the losers, that feels like a glass half empty kind of approach, doesn't it? I mean, is the aim here not to look at saying, okay, let's get more deal activity, yes, but you're actually looking and aiming for the winners in that segment? Is it just harder to pick the winners now?
I think what is critical for loan markets where the returns are broadly similar amongst all loans. A good loan will make about 1.35 times money for an investor, and a bad loan means you lose all your money. So the key, unlike equities, is to really avoid mistakes. Warren Buffett says rule number one is don't lose money, and rule number two is don't forget rule number one. And that's even more true in credit.
Talk to us about the appetite that you're seeing in terms of volumes out there, because it feels as though where some of the deal activity is, it is more mid-market space. Does that mean some of the credit deals you're seeing are smaller in size?
I think you're absolutely right to say mid-market volumes have held up relatively well. And at the larger end of the market, we've seen deal activity be a little bit more subdued. And that was really as a result, I think, of higher interest rates, private equity firms having difficulty selling assets in an environment where rates were higher. And as a result, deal activity at the larger end has been a bit slower. We're now starting to see that pick up as interest rates moderate. So look forward to, I think, more deal activity in private equity and private credit.
There was a view, too, that we need to get past the election, that the window that has been open for lots of deal making might see a bit of a hiatus with that election uncertainty. Do you agree? Is that going to be a problem?
I think that we're likely to see higher levels of activity across the board, regardless of the election. I think it's really a bit more rate-oriented and a bit more what is the receptivity for buyers to step in and get excited about acquisitions and the meeting of buyer and seller expectations in the M&A markets.
How much competition are you seeing out there, though, from the banks, some of the traditional lenders as well? Because we know that as net interest margins, that profitability the banks have been relying on for a while now as rates went up. That's not easy for them, so they're looking for other business. They want fee income. They want to be as active as they can on deals. Does that mean it's making it harder for private credit?
I think that the syndicated loan market broadly is much more competitive than it was a year ago or 2 years ago. We've seen margins come in dramatically, and that's on the back of strong buyer activity, principally from the collateralized loan obligations in Europe and the US. And so in the midst of that, banks can step in and underwrite transactions on the back of very strong buyer interest. And so, in a word, yes, the banks and the broadly syndicated loan market are absolutely back.
I want to continue that conversation then on banks as well. And it may not necessarily be global, but stateside, a lot of those regional banks had a few issues of their own then. Does the question marks around those regional lenders mean that private credit actually has a little bit more leeway in that market, something that perhaps people go to a little bit more?
I think you're absolutely right that the concerns around regional lenders in the U.S. has created more of an opportunity and window for private credit to step in. And I would say in both the U.S. and Europe, interestingly today, private credit really have become the relationship lenders to the broad private equity industry.
Fairly interesting then. What about the kind of companies you're attracting here in terms of quality that's coming forward as well? Has this quality sort of stayed the same? Has it diminished at all? What's that sort of been like?
I think the quality level within the overall private credit industry has increased dramatically in the past 10 or 15 years. If I roll the clock back 15 years ago, we saw a lot of small speculative borrowers. Today, we're seeing very high-quality businesses tap the private credit market, and it really is, frankly, the mainstay of financing buyout activity in both Europe and the U.S.
Talk to us about returns in the industry, because obviously interest rates are coming down a little bit now with that jumbo size rate reduction. What does it mean in terms of industry returns that we should be thinking about?
So we are floating rate in almost everything that we do, which is good when rates are rising, and then when rates are falling, that will result in a lower yield on the overall portfolio. The flip side, however, is that lower rate environment is excellent for transaction activity, and it's actually excellent for borrower health. So it's great to have very high interest rates, but at the same time, we want to make sure that the health of the borrowers is very strong.